Hello and welcome to The Upside. I'm Kyle Cheropita. On today's Upside, we'll count down the top 5 May highlights from our Fidelity Connects show. Connects is live daily for advisors and then available on replay for all as a video podcast. Markets in May began like April, with global markets experiencing volatility. U.S. markets faced challenges due to President Trump's trade policies, including the imposition of tariffs on imports from Canada, Mexico, and China. By mid-May, the market showed signs of recovery, accelerated by eased trade tensions and investor optimism. Canadian stocks have remained stable, as have global markets, notably European and Chinese markets outperforming, driven by strong economic data and investor confidence. So for clips today, number 5, Urian Timmer joins us weekly every Monday on Connects, with his replay available in the days after as a video podcast. Here he is on this past Monday's show with host Pamela Ritchie, sharing his views on the current market and macro environment.
Good morning. Happy Memorial Day from your friends down south.
Well, thank you for joining us on Memorial Day. We're very grateful. It is a holiday, so thank you. Good to see you.
You're my half hour of work on this holiday, but it's well worth doing. So.
Oh, you're the best. Okay, well, thank you. Tell us a little bit about where we've come, because it has been a fascinating track, pretty much right back to where we were prior to April the 2nd, and a very quick one, a true V-shaped, actually, if you will.
Yeah, so let's bring up slide 1. So it has been a pretty startling ride. You know, we kind of came out of nowhere and fell 21% in a matter of 6 weeks. And then we did a V-shaped recovery, almost back to the highs. This chart here shows what happens after a 20% decline. So the black line is the current cycle. And you can see we're following pretty much the most positive rebound you tend to see after a 20% decline. So this has been really good. If we took a 6-week nap, you know, we would wake up and be like, okay, nothing really happened. But of course, we know how much has happened, especially for you folks across the border. So the question now, of course, like what happens next, right? And if we look at slide 2, you can see just a zoom out here of the S&P 500. You know, when we declined the 21%, we came down to the previous high that held, and we just bounced very strongly. But for me, this now puts us in maybe a little bit more of a clearer situation, because what we saw, of course, last week was that, we saw 2 things. One is the 10-year yield went back into that 4.5-5% zone, and the 30-year Treasury went above 5%. And you know, as I like to say, that there used to be a saying that nothing good ever happens after midnight, and I would adjust that saying by saying that nothing good happens when the 10-year yield goes above 4.5%. And so we started to see that pressure that we've seen so many times now over the past few years, right? 2022, of course, was driven by higher rates, and then we had several sort of little rate tantrums as the 10-year yield went towards 5%, causing wobbles in the stock market. And you and I have discussed this many times. So that started up again last week. And at the same time, our president started talking about tariffs again. He started uttering the T word, this time directed at Europe. And to me, that's very interesting because, as we know, when the market was down 20%, the policymakers retreated a bit, right? They put they shelved the tariffs to China for 90 days, and of course they had shelved the other tariffs, the retaliatory tariffs, to all the other countries for 90 days, and so it was a White House put instead of a Fed put. But then, as the market recovers, people get more confident. They figure, okay, the market's like this. And lo and behold, you start hearing the rhetoric again. So that tells me that there are kind of like bookends now to this rally, right? I've long favored sort of this trading range idea for 2025, where earnings are growing, but the PE, which has already expanded a lot over the last couple of years, we can pull up slide 4 here, will start to come down as that Fed model starts to kick in. The Fed model meaning that as yields go up, they start pressuring equity valuations because equities need to compete with the risk-free rate, and if that risk-free rate gets close to what equities are yielding, the PE has to come down to reprice and remain competitive. So here you see the PE side really carrying the load over the last couple of years, anticipating an earnings recovery, which did happen. Earnings did rise 11% last year, but that cycle seems to have peaked. And now the PE side has given back some as well. So what this tells me is that when the market goes down, we have that policy put coming back in, right? So if this EU talk causes the market to kind of go into another tailspin, which I don't expect, but then as the market recovers, that rhetoric comes back and the Fed model kicks in. So all of that tells me that a trading range environment is probably the most likely outcome here for the next 6, maybe even 12 months, which is not the end of the world, right? No. Trading ranges happen when you have strong advances. And again, we had 2023, 2024, both 20+% gains driven by mostly multiple expansion. Having a flat year, which is sort of like in that range of down 20% to even, is something we've seen many times. 2015 was such a period. 2018 was such a period. And so to me, that seems like the most plausible outcome here until this whole episode kind of gets worked out.
Up next, number 4. Hugo Lavallee, who kicked off the month with May 1st webcasts in both English and French. French replay available by searching D-Log's Fidelity on your favorite podcast platform. Global markets are unique, and here is Hugo answering an audience question about where he is seeing opportunities right now.
So as a contrarian investor, you're there when others are running, which is...
Well, I try to be. It's not always perfect, but I try to.
But I remember our discussion in Beverly Hills last May, I believe it was, and you were focused on commodities, but you can change, you can be nimble, and that's what active management, you're the definition of active management, which is great. And we've had a question come in from one of our viewers just saying, hey, you're optimistic. What sectors or what themes are you seeing as opportunities right now?
Thank you for the question. So, there's a lot of things going on. On the European side, we're looking, Germany's going to stimulate. Can we buy some, good, unique European businesses tied to, the stimulus of the German economy? I've been underweight tech for like 2 years because there's nothing really contrarian in it. I can tell you that I've bought some tech stocks over the last month or so. There were some names that were really down and out. Some of them are reporting, decent numbers right now. That's one thing, an area that I've been focused on. Less so the AI pick them shovels, but other type of businesses that we like. It's just, there was really nothing contrarian about them, and maybe some ad tech businesses. And the world kind of freaked out, and maybe that's an opportunity. Probably the eye of the storm right now is consumer, like retail stocks, right? They're obviously in the eye of the storm for tariffs, probably recession. So I want to be prudent, but that's definitely one area that I want to focus on. There's really good quality businesses in travel. We all know, Canadians are not traveling to the US or less so. So that's, the market sniffed that out. It's crushed some high quality travel stocks. Is that an opportunity? Anything that's consumer, like I said, tariff related, but you got to watch the balance sheets. And then on the US side, I would also put, some of the hard cyclicals. They really took a leg down on this recession, early cycle cyclical, transportation. Is there some opportunity there? Like, I think some of the names are like 10 times recovery earnings. So that's interesting. So I gave you a lot there. What I'm not interested in, like I said, or less interested in, is safety. Gold, staples, Utes, some of the healthcare stuff. Whatever is not too cyclical, I'm not that interested in. And incrementally, I'm more interested in, can we find some businesses that can really kind of, and one great way to do it is you look at stocks that have been great stocks over the long run, right? And then you look at them like in the short term, things have been tough, and then you do like long-term valuation, balance sheet analysis. And that's one area I'm focused on.
So continuing what we heard from Hugo, next up is number 3, portfolio manager Steve McMillan and analysts David Cochran and Nick Everett. Steve shares how he has seen markets shift this year and the volatility creating buying opportunities. They also touch on the role of the equity research analyst team and how they contribute to the PM's funds.
Tell us a bit about these wild markets where you have been holding on, where you have been finding opportunity. Things are switching up a bit.
Yeah, I would think about it as like I was a shopper going around the grocery store and not being able to buy anything because everything was too expensive the last few years. Now I feel like I'm walking around that same grocery store and everything's on sale. And for me, this is a great environment. All of a sudden, I'm finding great businesses that I was really priced out of, now really coming into that basket of the portfolio.
How big are these companies? What's the range of companies that you're looking at? Their size?
So I've got my small cap America fund, and I typically keep stocks kind of under 10 billion, which from a Canadian context, there's probably only about 40 companies in Canada with a market cap above 10 billion. And then in the American equity fund, the sky's the limit. But mostly what I'm doing is focusing on all of the small and mid cap companies. And speaking of grocery stores, one of the largest holdings in the portfolio right now is a company called J.M. Smuckers.
Jam.
Exactly. And what I love about it is Folgers Coffee, which is the largest coffee brand in the world. Jif peanut butter, jam, Uncrustables. These are all products that you don't have to believe in humanoid robots. You don't have to believe in cryptocurrency. This is businesses that are stable, growing. And so I think we're seeing this rotation in the market away from dream stocks to cash flow stocks. And that's right where I sit. And so if you look this year in the first quarter, the best performing relative funds with the name Fidelity on them were managed by people like Dan DuPont and myself, because we're seeing this rotation away from those higher growth areas of the market to these more stable cash generative businesses. And so what I'm doing is I'm scouring the market, trying to find stocks that I think are on sale. And if you look this year, I've had 9% of my small cap portfolio actually taken out because
Really?
valuations are getting really compelling. Skechers was the most reasonable,
Yes.
The most recent. And what I'm doing is I'm relying on folks like Nick and David to find me those ideas. And they're doing a great job coming to me with these ideas.
Fantastic. That is so interesting because we've sort of been hearing about this. We were giving some real solid examples of how they fit in ultimately to your portfolio. David, I'll ask you to just explain what you do. You're looking at the consumer. We're going to ask you a lot of questions about consumer sentiment. What do you cover?
Sure. So I cover North American consumer discretionary, and that covers everything from restaurants and retailers to leisure products, think buying a new snowmobile or ATV, to leisure facilities like gym chains and other areas in leisure. So it's kind of the whole gamut within consumer.
Okay, fantastic. And Nick, I'll ask you to take us there. It's also related to the consumer, but this is financials.
Yeah, so I have the pleasure of covering U.S. non-bank financials, which is a broad term, but if we're thinking about the key parts, payments for me, so think like the Visas and the MasterCards of the world, all the way down the stack of different payments related companies. And then I have exchanges, so think the structure of the markets, companies that benefit from more activity. Generally, I have info services, so rating agencies, index providers. And then I also get, a smattering of more topical, growthier type companies in themes like buy now, pay later lending, cryptocurrency trading, and retail e-brokerage companies like Robinhood that are dealing with the U.S. retail investor.
There has been some trading going on lately. David, in terms of the sentiment that we hear about, which is a bit gloomy, let's be honest, there are lots of discussions about whether there will be or won't be a recession. What are you hearing CEOs say right now? And then we'll ask you, Nick, are people paying up for things? But first of all, David, the sentiment, is it just soft data? Is it something that, you're concerned about?
Well, I think what you're hearing differs within consumer from company to company. So what you're seeing is companies that sell big ticket items, think a new boat or an RV, they're seeing continued soft demand. even as compared to last year, which was also soft. So really folks being a little more hesitant to pull the trigger on buying those big ticket items. On the other hand, you're seeing the everyday essentials, some of what Steve talked about, where people are still buying their peanut butter, whether or not there's a recession. And then you have areas in the middle, like travel and restaurants, where you've seen a little bit of softening after some strength. You've seen some softening to start 2025. And the question is, okay, is this the beginning of something, or is this just a blip? And, this is the kind of environment that we really like at Fidelity, because we meet with our CEOs all the time. We're constantly tracking data. We're talking to industry experts, and we're trying to figure out how do these diverging trends create opportunity for us to form views on what these companies could earn and where those views diverge from the stock prices.
Okay. All right. So we'll do more on that. First of all, Nick, what about on the payment side? Are people still paying up? What are you noticing in terms of trends within payments?
Yeah, so we get to see these trends pretty closely. I mean, Visa and MasterCard effectively encompass spending for the entire world, but specific to the US consumer, what we've seen is they're holding in. So despite softer sentiment metrics. So through the first quarter, there's some noise around things like weather or leap day timing, but if you're looking through it, it looks like spend trends are generally holding in a good place. And specific to April, which is where there's a lot of focus, given this is coming after this novel trade war environment, we've generally seen spending hold in, but with a couple of caveats, which is that we're seeing some category shift under the surface. So specific to April, it seems like we're seeing weakness in pockets like travel and leisure. And where we might be seeing some strength is in categories that the consumer would perceive as tariff pull forwards. So think consumer electronics, maybe you're pulling forward your iPhone purchase because you're concerned about tariffs coming in and taking prices up for that product, or we may also be seeing some strength in autos.
Our clip number 2 is Dave Way, portfolio manager of Fidelity Long Short Alternative Fund, on how 90% of his fund is within North America and 10% elsewhere. He comments on what opportunities he is finding for both the long and short side of his portfolio, his strategy behind when he adds names to both sides of the portfolio, and his thoughts on various regions.
I think it's quite clear that bond spreads are perhaps not pricing in the level of distress and default risk that we might see in the next couple of years.
What does that make you do with your short side of the portfolio then?
For me, one of my core bread and butter shorts are companies that are not growing and have too much debt, because you really have to operate from a position of weakness where every quarter you're working to keep things alive. And the reality is, as we saw in April, a lot of these stocks really suffered. And operationally, their ability to navigate through tariffs is weakened by their financial position. So this is really an environment where perhaps the strong may get stronger, the weak get weaker. And if bond yields remain elevated, the odds of financial distress in this sort of cohort of stocks increases, which makes them attractive short candidates.
That's interesting. Give us the universe that you invest in. Remind us. You're across North America. You can also go international. You have a trip coming up, actually.
I do. So my primary benchmark is North America, so Canada and the US. And it's a sort of prospectus requirement that 90% of the fund is invested in those geographies. And then with the residual 10%, I have the ability to have some flexibility. And there has been some interesting developments in Europe over the last couple of years. It's been really like a growth desert for 15 years.
Last couple of years, you've seen opportunities, because it seems like it's just a this year story. But
yeah. So I think the Ukraine war in 2022 really caused the beginning of a major rethink about how the European economy is ordered. I would say the 15 years before that, in very broad strokes, would be a path towards deindustrialization, trying to meet green objectives by closing plants and closing electrical generation in Europe and moving those plants abroad, principally to Asia and China.
And all on cheap gas.
And all on cheap gas. And I think the reality of the Ukraine war highlighted the relative insecurity of that policy. And so last year, my exposure to Europe, largely consisted of exposure to the defense industry. Right. I think people thought that the end of the war in the Ukraine would actually bring a decline in defense spending. And it was my position that the war in Ukraine will likely ultimately end by the removal of the security guarantee that has, largely protected Europe, the US, since the end of World War II. And that would require basically Europe to go it alone and spend more on defense. And so I think that was sort of the first leg of opportunity. And more as we look forward, it's really about the potential for fiscal stimulus. Like Germany has a very low debt to GDP. They actually have the ability to stimulate the economy if they want to. And I think the security angle is really the thing that is pushing them to take the steps to do that. And so I am going to Europe, and I'm meeting with about 25 companies across industries looking for opportunities. So I've done some work. I have some hunches about where the opportunities might rest. But for me, it is an important part of the process to go meet companies, test my hypotheses, and hopefully, I get 2 or 3 ideas out of there that can supplement that sort of the rest of the core portfolio, which I remain excited about. Like if Europe's an opportunity, there's a lot of US companies that have European businesses. And so part of some of the areas where I'm interested in Europe, the stocks to buy are actually still in the US. So I know there's a lot of hand wringing about, is capital going to flee the US markets and go back to Europe? Or does the US still have a path forward? Yeah, it could just be an additional growth driver on a stock that we already think is attractive. So for me, it's really about balancing that. If I do go into that like 10% sort of outside the benchmark, I want to be really confident that it's a good idea, and I want it to provide a unique exposure or access to an opportunity that I can't source in North America.
Okay, fascinating. We'll obviously have to catch up with you on that. There's a question coming in. You've noted some of these points. Maybe just wrap it up for us. Are you finding, David, more long opportunities outside the US? Are you finding more shorting opportunities in the US market?
Yeah, I think in the US, the rapid snapback we've seen tells us.
Is that going to hold? What do you think?
Personally, my main concern is that the market is really discounting, a material impact from tariffs. And I think in the very short run, what we're seeing is potentially some pre-buying as people try to front run higher prices. We have Walmart's CEO saying that they are going to have to take price increases. And so when you see higher expectations for prices in the future, it tends to pull forward demand. So some of the numbers actually have been relatively strong in the quarter. And for me, what I'm worried about is if we do see tariffs, these tariffs will have impact on cost structures. It will lead to price increases, potential risk to demand.
For U.S. companies.
US companies, but there's like always great companies. Like for me, it's really becomes one part of the thesis. And if you have a company that is doing something else, maybe they've sold a division that was a huge problem, and now they have a clean slate and a clean balance sheet. Even if they're tariff affected, they can be great stocks.
Right. Okay.
And so it becomes. But I would say that from a name count perspective, I am buying more stocks in the U.S. than I am buying in Europe. And on the short side, like this rapid snapback and sort of kind of buy the dip approach. A lot of the shorts I covered in April, could be very attractive again because they've all bounced back.
Okay.
And so I think from a short perspective, I'm definitely finding a lot of ideas, which I need, because when we got into early mid-April, a lot of the stocks got bombed out, and I don't necessarily wait to replace them with a different short. So, if you're covering shorts, you need to constantly be refilling the pipeline. And so for me, I just kind of go through the 200 stocks or so that I know really well and have a thesis around when I'd short them. And if the price gets to a level where I get comfortable about the risk reward, it's time to put them back in the fund.
Tariff fears have rescinded slightly, but still remain part of the global market story. Our clip number 1 today is portfolio manager Joe Overdevest, sharing an update on company meetings, tariffs, and the Canadian energy sector, particularly the oil and natural gas industry.
You always want to keep an open mind that like sometimes the stock maybe have come off so much, so much is already priced in, that it's actually attractive. Okay. But I would say there's a lot, even we had discussions this morning with the CEO, and I will say, I said, what if you do this? What if these tariffs come in on Canada? What if these tariffs come in? Like, how do you deal with that? Are you raising prices? Are you moving your production to the US? These are very big questions for some of these companies.
Okay, so let's go to sort of the energy side of things, and we'll come back to other pieces as well. But so oil prices are a nice cushion for the economy globally, actually. They've come down significantly for lots of reasons that we know. With that said, there's a big energy story in Canada that we think might get built out, but we really don't know. Take us as an investor, how you're looking at a new government, some promises, but legacy issues as well. Do you dip your toe in there yet or what?
I think the energy companies in general look probably more attractive here just because the oil prices come off. Low 60s is attractive, and we're actually seeing for the first time in many years the Permian, which was the biggest driver of oil growth, which is Texas oil basin, dropping rigs. And so Diamondback Energy, which would be one of the premier companies in terms of size and growth, they actually are, drop back their capital expenditures. So that's a good sign. So it means supply is starting to adjust. For commodity, you usually get more bullish there. You want to see that what we call the marginal cost of supply, right, is starting to adjust. So when we go back into Canada, you made a great point. We're starting to hear headlines as of this morning that maybe the Liberal government will be more friendly to oil and gas. I would state right now, talking to oil and gas CEOs, I think they are happy. They are receptive. I think, though, trust is earned by action and trust is earned over time. And so I think they're watching very much the actions of the Liberal government and making sure that's consistent over time. One of the bigger things that the audience might ask, then, what does this mean in terms of capital expenditures? I would say oil and gas drilling in Canada, I wouldn't really see a big change here because they're more sensitive to the oil price. And oil price being low 60s, most oil and gas companies aren't very excited. Even Canadian Natural Resources recently brought their capital expenditures down a slight amount. But on the margin, probably people are cutting, not adding. The bigger issue, though, is, as you're alluding to, is the big projects, oil pipelines, LNG, Canada.
To supply potentially Canada, but also to diversify away from the U.S. What's the talk?
Right now is that it's positive in that probably for the last few years, that talk was at least non-existent.
Yeah. Don't bring it up.
Yeah, don't bring it up. So at least now it's being talked about. And so these are long-term solutions for Canada, which is positive because part of our tough negotiation with the U.S. administration is that really the biggest tool we have is energy. But if we shut down the energy, it probably hurts us more than it hurts them. Right. So what we really need is longer term is we need to bring oil and gas outside of Canada. And that's oil pipelines, that's LNG. We have the ability to do that. I would say it's still very political in that oil has to probably cross maybe Quebec if you want to do expansion that way. And so for, past pipelines for this audience may not know, but some of those pipelines have been proposed in the past and been shut down. And
we hear about an energy corridor across the country. That seems to be also a discussion somewhere.
Yeah, and I think it just right now it's low probabilities of crossing multiple certain provinces. Just because, again, there's a sensitive history. And at least in Canada, again, we're probably different in America that way. And is that we're not forcing certain provinces. Whereas America might do that. That's not our style to do that. But I do think on the margin, we can definitely expand, TMX pipeline in the West without a lot of...
It's already there.
It's already there.
Just make it bigger.
And LNG Canada, we can expand that as well, which would help our markets, yes.
So that does it for today's show. I hope you enjoyed all of those clips. So as mentioned, for more, you can find each clip as a full video podcast, available on YouTube, Spotify, Apple Podcasts, and more. We're putting out fresh content daily, so please look up the Fidelity Connects podcast. I'm sure there is a topic there for everyone. And as always, for more from us, please keep an eye on Fidelity Canada's LinkedIn, YouTube, or Instagram. So thank you for watching today, and I hope you'll join us again on the upside. Please keep an eye on your email to not miss an invite to the next episode. I'm Kyle Cheropita.